Hello, my name is Gabriel, and I'm joined by my colleagues Yusuf, Vince, Mark, Wazi, and Daniel. Today we'll be discussing 3P Turbo's proposed expansion project into Brazil. I will begin by providing an executive summary of this presentation. 3P Turbo is an American-based automotive turbocharger manufacturer that aims to take advantage of the increased demand for their products to expand internationally. To assess the financial viability of the expansion, we calculate the net present value of the project, consider the different types of finance available to the company. Based on our numbers, the project achieves the highest positive NPV when the investment is financed by the German vendor, indicating that the project should proceed with this financing option. In addition to the project's financial assessment, we also mapped and analyzed the risks of investing in Brazil that might have a negative effect on the profitability of the project. More precisely, 3P is considering an expansion into Brazil as an avenue to increase its global market share. The company's strategy is to take advantage of the heated demand for high-performance auto parts that combine power and efficiency. The rationale behind the choice to open a factory in Brazil lies in the fact that the Brazilian automotive industry provides critical strategic advantage for 3P. For instance, this expansion offers 3P access to a large portion of the South American market through Brazil's participation in the Mercosur Trade Pact, which grants free trade among the 10 full and associated member nations. In addition, expansion into São Paulo allows 3P to avoid the high import tariffs for foreign goods and satisfy the local content requirements for products sold in Brazil. Moreover, 3P will acquire an abundance of highly skilled labor readily available in the automotive sector. As a company that prides itself on high-performance products and excellent technical support, secure and qualified workforce will allow 3P to maintain its value proposition. These factors underscore the advantages opening a facility in São Paulo will have on capturing market share in the region and increasing barriers to entry in the sector for competitors. However, some inherited risks to investing in Brazil should be noted. All those risks are covered in our presentation and will be discussed in detail later on. Now I will pass to Daniel.
Thanks, Gabriel. A project's discount rate should be the cost of capital, or the return that investors expect on projects with similar risk and length. The traditional CAPM model states that the expected return on equity depends on a linear relationship driven by the correlation between the returns of the underlying asset and the overall market, better known as the beta. In perfectly efficient markets, CAPM states that investors are able to diversify away from idiosyncratic risks and thus should not be compensated for firm-specific risks. In a world where global markets are perfectly integrated, investors could freely exchange currencies and access foreign information to create diversified portfolios without market-specific risks. Thus, CAPM would correctly state that the expected rate of return would only depend on global systematic risk and not on any foreign market. As a result, in perfect global market conditions, investors only hold globally systematic risk, and CAPM would be the only appropriate model to determine the discount rate for foreign investment. Although some investors would be concerned by the low cost of capital produced by CAPM and forward markets, it intuitively does make sense because different geographic capital markets will remain mainly uncorrelated with one another, thus providing a low beta and increased diversification. However, in reality, markets aren't perfect. There are numerous market-specific risks that investors are uncomfortable with when dealing with foreign investment, such as corruption, exchange controls, expropriation, high transaction costs, and many more. Many investors will adjust CAPM to account for these additional market-specific risks. The Solomon-Smith-Barney, better known as SSB model, is an approach that some practitioners use in an attempt to measure discount rates for foreign investment. This model adjusts CAPM to consider the company's access to capital markets, the industry of the proposed project and its probability of expropriation, the characteristics of the investing company and project, and the proposed country of investment. The SSB approach begins by calculating the yield spread between the country of investment and the domestic market. This yield spread acts as a proxy to model the additional risk from investing in the foreign market rather than the domestic market. From there, practitioners must engage with relevant data to determine three factors regarding the company. Firstly, we must decide what the degree of access the firm has to the capital markets. Next, we evaluate the accessibility of the project and the relevant industry to political risks such as expropriation. Lastly, we must account for the degree of financial importance of the project for the company. This is important as it accounts for the impact on the company's durability should the investment project be unsuccessful. A key point to emphasize is that practitioners assign the beta of the project to the industry's systematic risk with respect to the world market, not the foreign market. Now, with regards to 3P, the organization operates in a well-integrated market. Therefore, its investors have the ability to diversify away from idiosyncratic risks relative and present in the Brazilian market. As a result, 3P should use CAPM to calculate its cost of equity. In addition to this, it needs to account for the sustained difference in inflation between the US and Brazil. Thus, we utilize the purchase power parity formula. As a result, our inflation-adjusted discount rate to discount the Brazilian real cash flows was 17.55%. Next, I'll pass it off to Wazi to discuss our capital budgeting analysis.
Thanks, Daniel. In terms of the capital budget analysis, excluding the loan from the German vendor, there was a number of assumptions and inputs that we had to consider. First of all, we had limited information, so we took management estimates for volume, prices, and costs. One assumption that we did make was that the initial cost of the building equipment of 120 million Brazilian real would be straight line depreciated to 0 Brazilian reals after 5 years. Now, since we are depreciating it to 0 and selling it for 30 million Brazilian real on the 5th year, there's a capital gains tax of 30%, which amounts to 9 million Brazilian real at the end of the 5th year. In terms of the exchange rate analysis, the US and Euro inflation was expected to be at 2% for the duration of the 5 years, which is in line with historical averages. Now, the Brazilian inflation rate, it rose to 9% under Rousseff, and although Temer, President Rousseff's predecessor, has promised to bring it down, the 2018 presidential forerunner, Ackman's pro-business policies, may overheat the Brazilian economy and cause inflation to stay at this high level of 9%. So we are assuming that Brazilian inflation will continue to be at 9% for the duration of the 5 years. In terms of future spot rates, they were calculated using the PPP theory, which essentially takes into account inflation rate differentials when predicting future spot rates. So all in all, in terms of our cash flow forecast and NPV analysis, the Brazilian cash flows were discounted at the Brazilian discount rate of 17.55%. That was Daniel was speaking about. The total NPV of the project in Brazilian real was negative 5.8 million. And the total NPV of the project in US dollars was negative 1.64 million. And because the NPV is negative, we recommend that 3P Turbo should not pursue their project when it is all equity financed. And with that being said, I'm going to pass it over to Yusuf to cover our loan analysis.
Thank you so much, Wasi. Although the project yields a negative NPV when it's all equity financed, 3P has the opportunity to secure low interest rate debt financing for this project from a German vendor. Leverage creates value in a project through interest tax shields and management discipline. And in cross-border projects such as this one, leverage can also influence the project's value through currency fluctuations, especially when there are significant inflationary differences between the countries involved. So we therefore assess the viability of this project, taking into consideration this financing option. The 22.5 million euro, 2% loan from the German vendor required fixed annual payments of just under 4.8 million euros. Using the same methodology for exchange rates that Wasi just highlighted, a future euro-real spot rate was projected for each period. Again, since the real is projected to experience much higher inflation than the euro and devaluate, the real equivalent of these fixed euro debt obligations increases through the time horizon. We then determine what the new cash flows to equity would be as a result of this financing option. The future cash flows are much lower due to the debt repayment obligations, but the initial capital outlay is also significantly lower since just about 75% of the capital investment is now financed with external debt. By minimizing the USD denominated capital outflow up front, the project becomes more valuable as the high foreign cost of capital largely reduces the value of future cash flows of the project. These equity cash flows were discounted at the foreign cost of capital stated earlier, and the small debt tax shield generated were discounted at the cost of debt. This analysis yielded a positive NPV of $3,795,000 USD, making the project viable once debt is taken into consideration. Moreover, we found this to be the shareholder value maximizing option, and thus the optimal financing choice for 3P. The $3.8 million NPV is $5.4 million higher than the NPV of the non-levered project. Assuming that 3P has the option to pick any of the other financing alternatives, we analyzed each one for their NPV impact. In the absence of the 2% German vendor loan, 3P's next best alternative is to borrow from the Brazilian bank at 15%. This option yields an NPV of $2.5 million, and since this is the next best option, we concluded that the true value of the German vendor loan is $1.4 million. The value of the loan stems from both the interest tax shields, although this is minimal, and the high depreciation of the Brazilian real. Particularly, the Brazilian real is projected to depreciate significantly relative to the US currency over the next 5 years due to the inflation differences between Brazil and the United States. Another important thing to note is that the low vendor financing option results in a highly levered 3-to-1 debt equity ratio. Importantly, this is above 3P's desired one-to-one capital structure. Because of this, we also analyzed the 2% German vendor loan at a one-to-one debt equity ratio, which yielded a much lower NPV of approximately $2 million USD. Thus, although this is not optimal, the structure remains a viable alternative should 3P wish to preserve its target capital structure. I'll now pass it off to Mark to discuss the risk analysis performed for this expansion project.
Thank you, Yusuf. I'll now evaluate the various risks that are inherent in 3P's expansion plan in Brazil, specifically financial and economic, political, and operational risk. Many financial and economic considerations are present in international expansion. Brazil, an economy closely tied to commodity prices, is subject to international market volatility. A potential slowdown in trade between Brazil's key partners could negatively influence Brazilian exports, resulting in a devaluation of the Brazilian real. In addition to commodity-induced currency risk, Brazil is also facing an inflationary crisis. The lack of independence of the Brazilian central bank in fighting inflation may result in late responses to the crisis and increase the possibility that inflation spirals out of control. With the upcoming 2018 presidential election, further economic instability is likely. The frontrunner is pro-business and will likely cut taxes, increase spending, and decrease interest rates, resulting in an overheated economy on the verge of high inflation. The impact on 3P is twofold. Inflation will devalue the Brazilian real relative to the USD, deteriorating profits, whereas a high debt burden on this specific project will be more expensive for 3P as the debt will be denominated in euros. Regarding political risk, two recent examples clearly illustrate Brazil's inability to commit to recognized agreements due to political factors. Firstly, the Mercosur agreement, and secondly, the Inovar tax incentive. The Mercosur agreement increases the attractiveness of Brazil as a destination for FDI, as the trade pact allows member countries to trade with zero tariffs. However, former Brazilian President Rousseff violated the rules of the pact in increasing tariffs on automobiles. This scandal put the entire agreement at risk of collapsing. Regarding the Inovar auto tax incentive, which provides tax incentives to automotive producers supporting domestic innovation and fuel efficiency, President Rousseff failed to extend the act prior to impeachment in 2016. This is troublesome as the agreement is not applicable beyond 2017. This constant reshuffling will continue to pose risks for businesses seeking to expand into Brazil. Changes to existing agreements may result in firm-specific challenges for 3P, such as decreased demand for cars, increased competition in the Brazilian market, and lower operating profit. Regarding operational risks, inefficient bureaucracy makes Brazil a complex country in which to do business. 3P must consider custo Brazil, or the Brazil cost, which is the high operational costs associated with doing business in Brazil due to high tax burdens, high labor costs, and poor infrastructure, amongst other factors. Of note is the country's highly skilled and capable workforce, specifically in the automotive sector. However, rigid labor laws and high wages will deteriorate profits through the increase in production costs. I will now pass on to Vince to discuss our at-risk sensitivity analysis for the key project drivers.
Thanks, Mark. So in order to quantify the impact that some of these risks would have on the NPV of the project, we conducted an at-risk sensitivity analysis. Since cash flows are denominated in Brazilian real, but profits and debt payments are denominated in USD and euros respectively, we determined currency inflation risk would be the most important risk to sensitize our analysis to. We first analyzed the historical average inflation rates of the Brazilian real, euro, and US dollar, and concluded that the historical data fit roughly as normal distributions. We then projected out future inflation rates for these three currencies using a time series analysis to give us a sense of the possible range of future inflation outcomes for each currency. The Brazilian real inflation rate was the most variable, with a band between 2 and 12%, and the other two currencies had a much tighter inflation distribution, roughly between 1 and 4%. Now that we had a range of outcomes for possible inflation, we applied a Monte Carlo simulation to assess the impact of these ranges on the project's NPV. The simulation concluded that the optimal German vendor loan at a 3-to-1 debt to equity ratio still has a positive NPV at a 99.2% confidence interval, alleviating most of our concerns over currency inflation risks. In addition, the regression coefficients of the analysis revealed the relationship that each of these variables has on the project's NPV. The US and Euro inflations have a positive coefficient with respect to NPV, and this was predictable as inflation of these currencies will result in their relative devaluation to the Brazilian real, thereby making project cash flows more valuable upon conversion back to USD. Conversely, the Brazilian real had a negative coefficient on the project's NPV. Again, this was predictable because as the currency inflation occurs, it will devalue relative to the US dollar and diminish the project's cash flows after conversion. Finally, we performed a sensitivity analysis on the project with respect to the three currency inflation rates under different financing arrangements. We looked at the next best alternative, the Brazilian bank loan, and the management target 1-to-1 capital structure using the German vendor financing. For the next best alternative, the NPV, unsurprisingly, is not sensitive to euro inflation as the debt is now denominated in Brazilian real. And in this option, the NPV is primarily sensitive to the US inflation as this impacts the after-tax conversion, or the after-conversion returns, the main drivers of profit. And for the target capital structure of a 1-to-1 debt to equity ratio using the 2% German vendor loan, the project NPV sensitivity to euro inflation is mitigated because we're now borrowing a lower amount of euro denominated debt. So to conclude, 3P should pursue the expansion into Brazil utilizing the 2% German vendor loan as it generates positive NPV of just under 3.8 million USD, which is the shareholder value maximizing option. 3P will be able to maintain its value proposition while expanding its market share in the South American region and gain a first mover advantage. They can proceed with caution or with comfort, as despite sensitivities to currency fluctuations, the project yields a positive NPV at the 99.2% confidence interval. Thank you.